Hello and welcome to Property Question Time. I'm Bryony Bilson and this is the show where you get the chance to have your questions answered by our resident property experts. So let's see who we have in the hot seat today. First of all, a warm welcome to Paul Mahoney, founder of Nova Financial Limited. We also have James Jenkins from Money Sprite. And last but by no means least, Tony Gimple, founding director of Less Tax for Landlords. Well, today we're going to be looking at quite a wide range of subjects. Again, most of them sent in by you. We'll be looking at everything from debt consolidation to changes in the buy-to-let market. Now, my first question goes to Paul. And it says, I'm considering using the equity in my current home to enable me to buy a smaller property to rent out. The figures work out in principle, but is there anything that I might not be aware of which could turn my modest monthly cash positive position into a negative?
Well, it's very important to make sure that you're over accounting for costs and under accounting for returns. And it's sort of surprising how many times we come across people that do their calculation in the back of an envelope. So accounting for things like property management, maintenance, service charges, ground rent, whatever might go into maintaining this property and keeping it running. But also accounting for things like vacancy rates, potentially lower rent than you expected. If you do over account for costs and under account for your returns, then you probably won't be surprised to the downside.
Brilliant, thank you. And I mean, if I wanted to do something more than use a back of an envelope, what would you recommend for?
Well, there's a range of quite useful spreadsheets that you can get off the internet yourself, or you can seek advice from a professional advisor that would put together a much more comprehensive calculation for you.
So you think the answer really is in getting the detail?
That's right, yeah.
Brilliant, thank you. Thanks, Paul, that's fantastic. My next question is going to go to James. It says, is there such a thing as a property angel? Someone prepared to buy a property along with first-time buyers to help them get on the property market, but also to give the angel part ownership until an agreed buyout?
Okay, well the simple answer is no. However, there are various other schemes and ways that you can get to a similar outcome, if you like. So a lender wouldn't accept a third-party company coming in as a part owner in a property. It would be deemed as a commercial transaction, so they wouldn't accept that. However, your property angel could be a parent, a brother, a sister who comes in with you on the mortgage if you're struggling for affordability. That's always a possibility. Or it could be using things like the government Help to Buy scheme, the shared equity, where the government will lend you a bit of money towards the purchase price, or a shared ownership property where you part rent and part buy. So a property angel as a company, no, but there are other schemes where people can come in and help you to purchase, take advice from a financial advisor and see what's out there for you.
Brilliant, thank you. And so do you think involving family members or friends in this is a good step forward for a lot of people?
Yeah, absolutely. And there's various different ways that lenders are changing the way they look at mortgages to allow this to happen. Certain high street lenders, Barclays, have got a springboard mortgage whereby the borrower can borrow 100% of the purchase price and the parents can put money into a savings account which is locked away for 3 years, and that's used as effective deposit or security for the mortgage lender. That avoids the parents actually having to go on the mortgage. But other mortgage lenders are also allowing parents to go on the mortgage and on the deeds of the property or not on the deeds of the property. So they're becoming much more flexible to allow family members to help rather than just what's historically just been mum and dad giving you money. Mum and dad can actually go on and help with the mortgage borrowing now as well.
Fantastic. And would you always still recommend having a financial advisor involved in that process, particularly if you are including parents?
I would, yeah, absolutely. A financial advisor is going to have a far wider understanding of what deals and options are available in the marketplace. Talking to your own bank will only be able to tell you what your own bank can do, and if your bank doesn't operate a scheme like that, you may never be aware of it. So absolutely talk to a financial advisor who would know about these different schemes and can explain the advantages and disadvantages and meet all of you at the same time.
Brilliant. Tony, I noticed you nodding there. Is it an area that you have some experience with as well?
Yes, we see it a lot with our clients where families, even friends, extended families, all cooperating together, almost in the Southeast Asian model of pooling wealth to create wealth. Works very well. Devil's in the detail. Families and money can be pretty toxic. So it's really important that everybody understands how it works and they have the right agreements in place.
And Paul?
Yes, I think it's a bit of buyer beware in some cases with the property angel type arrangement. There's a lot of people out there promising to allow you to buy property with no deposits, and a lot of these property meetings and things where in a lot of cases, well, almost all cases, people are in property to make money. So you need to be a little bit careful where you're being promised an arrangement that doesn't really stack up or seems too good to be true.
So my next question's to you, Tony. It says, I'm 5 years away from paying off my mortgage. The value of the property is currently $750,000. I want to make sure that when I do have it paid off, I can protect the value of the house for sharing among my children without losing any of the value in death duties or other taxes. Can I assume that pre-planning this is the key and that there is a way that I can do this?
Absolutely, proper preparation will always give you the best performance. Assuming that you both survive, for the 5 years till the mortgage is paid off, and then fall off your perch, and the law hasn't changed, you'll be able to pass on in total £1 million worth of assets to your children and direct descendants for the part that comes from your house without the burden of inheritance tax. Anything above that will be taxed at 40%, although there are some exceptions.
Brilliant. Why do you think this area is so confusing for so many members of the public?
Because the law has evolved, tax law has evolved. What was once simple has now become much more complex, different assets, different social goals, and people will need a degree of professional advice.
Brilliant, thank you. Paul, do you have any experience in this area?
Well, only that I agree with Tony. Seeking advice on these things is very important, especially as you start to build wealth. It becomes more and more important. As Tony mentioned, it's essentially a tax on the wealthy. And as that wealth builds, the repercussions of it become larger. So seeking advice and doing it, in the right time. Don't wait until you're going to fall off the perch, as Tony says. Do it well and truly in time, because the more you plan, the better the outcome you'll achieve.
Brilliant. James, do you think that is really the key to the recipe here, thinking ahead, pre-planning?
Yeah, I couldn't agree more with either of these two guys, actually. It's all about planning early as you can and making sure that you've got every base covered as best as you can with what you're in possession of the facts at that time. Yes.
Brilliant, thank you. Well, some fantastic answers there to some quite challenging questions from our viewers. We are now going to go to Paul for a golden nugget. Paul, what piece of information are you bringing to the table today?
Well, there's been quite a few changes in the buy-to-let market recently, and the three main changes recently have been, firstly with regards to the way that mortgage interest is to be treated from a tax perspective, secondly a stamp duty premium for all second property purchases and any further property purchases, and lastly mortgage serviceability. And all of these changes are causing a lot of uncertainty and a lot of change in the market on how best to deal with them. Very simply, the best way of getting around each of these changes and what's causing quite a big shift in the market is a shift away from high value, low yield assets. And if we're talking about the UK, that's predominantly London and the southeast, toward lower value, higher yield assets. Because if you're getting a higher yield, the tax doesn't hurt you as much. If you're buying at a lower value, the stamp duty doesn't hurt you as much. And again, if you're getting a higher yield, then the mortgage serviceability issues don't hurt you as much either. So I suppose, I've simplified it there, but making sure you know how these things are going to affect you and how you can deal with them moving forward is very important.
Brilliant, thank you. An excellent golden nugget there with lots of advice and tips. We are now going to have a short break, but we'll be back soon with more questions and golden nuggets from our property experts, so don't go anywhere. Hello and welcome back to Property Question Time with me, Bryony Bilson. So we're back with our panellists today. We've got Paul Mahoney, James Jenkins and Tony Gimple. And I'm going to go straight to James Jenkins with his golden nugget of today.
Okay, so today we're looking at debt consolidation. historically, in the mortgage world, people have borrowed money on loans, credit cards, car finance, and then looked to consolidate that debt up with their mortgage payments to reduce their monthly outgoings and therefore wipe the slate clean effectively. Now, that for years and years has gone on, but currently now that's becoming a very hot topic within the Financial Conduct Authority, whereby as advisors now we're being strongly encouraged to deter debt consolidation, to look more closely at what the client's interest rates they're paying on these loans and credit cards. A good example of that is if you now have 0% credit cards, it's very unlikely that it's going to be seen as good advice to consolidate those debts up with your mortgage. So the main thing is to make sure that clients are aware that they're not looking to just take debt out and then put it on their mortgage. A lot of lenders these days will only allow one lot of debt consolidation. If you try and do it again, they're not going to allow you to do that. So your choices in terms of being able to debt consolidate are disappearing. So really it's a bit of a warning and a bit of a thing for people to be aware that that option of just keep pounding debt into the mortgage could well be disappearing over the short to long term, or so medium to long term.
Brilliant, thank you. So really be aware of your options and that they might be a bit more limited now.
Absolutely, and take advantage of the fact that there are 0% credit cards out there. So if you've got 0% credit cards coming to an end, don't automatically think of rolling it up and saving money monthly by putting it on your mortgage. That's going to mean you're paying an awful lot of interest over an awful lot of time compared to what you were paying on a 0% credit card. Mm-hmm. So yeah, make sure you think things through properly.
Perfect, thank you. And Paul, did you have anything to add in that area?
Yeah, well, it's been quite widely reported lately that consumer credit's been rising. And that's potentially why the FCA is getting concerned about these things, because people don't see it as something they need to ever repay, but of course you do. So sometimes a bit of short-term pain can result in some long-term gain. And also understanding the difference between good debt and bad debt. And my differentiation there is good debt is investment debt, it's debt that helps you improve your finances, whereas bad debt is consumer credit, even your home loan. It gives you somewhere to live, but doesn't improve your finances.
Brilliant, thank you. But debt's still debt at the end of the day, but be aware of what debt's driving you forward and which ones are dragging you back.
Correct, absolutely.
Excellent, thank you. Excellent golden nugget there. Thank you, James, and to you, Paul, for adding to that. My next question is going to go to you, Paul. And it says, I've seen that there's hardly any small commercial properties available in my area, especially offices. It makes me think that buying a large old house as an investment and renting it out as serviced offices might be a good idea. Any thoughts on this?
It could be a good idea in the right circumstances. I'd be very wary of that because it's definitely against the current trend. Pretty well all councils are encouraging people to do the opposite. There's a major shortage of residential property, pretty well UK-wide at the moment. So to take a large residential home and convert that back to office space or commercial space seems against that trend. But if there's a lack of supply in the area and a strong demand, it could certainly work. But I do thorough due diligence on it before going into that. There are obviously other options. You could take a large home and turn it into a HMO or split it into multiple residential apartments. In the right circumstance, the yields are slightly higher on commercial property, but the vacancy rates are also much higher. Other things to consider would be the finance that would be associated with that type of property, the costs of that finance, the terms, how that works out so far as your net returns go. So there's a broad range of things to consider. It's hard for me to comment without knowing where it is and what it is, but that's some of the things to take into account.
Thank you. I mean, do you think you would get planning for something like this, turning an old house into
I'd be
offices?
surprised, to be honest. As I say, councils are encouraging the opposite. So that there's permitted development rights at the moment, which encourages developers to turn office space into residential to plug the gap in the housing supply at the moment. So that's obviously something you'd need to check as well.
Tony, have you had any experience of this, particularly turning houses into offices?
Clients in the property sector have got a wide range of options open to them. But it's as Paul said, it comes down to what is a business decision. Is there a lack of supply? Is there a demand? Will the local authority play ball? Can they make it work as a business decision?
Brilliant, thank you. Great thoughts to kind of keep in mind when making those decisions. My next question goes to James. James, the question that's come in is, I want to convert a disused barn into a dwelling. Once I've got my figures for the conversion worked out, what would I be able to borrow against it? The existing value of the barn, which is obviously very little, or the value of the property after the work has been done?
Okay, really good question. And it does always depend on the client's individual circumstances. So we would look at all the client's situation. Do they own a property currently where they live? Could we raise finance, secure it on that? That gives them liquid money to be able to do the development. There are schemes out there where basically, depending on whether they own that bit of land at the moment, because it's not the value of the barn specifically, it's the value of the barn with the land and whether it's got planning permission, because obviously that would increase the value of that land quite substantially. So what you can do, if they own that already with no mortgage on it, some development companies will allow them to borrow 30 to 50% of the value of the land to start that building going. And actually in some circumstances you can borrow up to 100% of the build cost.
Really?
Normally it is paid in arrears, so you'd need to make sure that you've got money to pay for that stage of the build and then effectively claim it back from the mortgage lender. The overriding thing is that the overall borrowing can't be more than 50 to 60% of the value of the property once it's completed.
Right.
So the answer to the question is actually both. You borrow against the value of the land as it is now, effectively, but the overall debt and what you can borrow is it's worked out based on the ultimate value of the property and not exceeding certain loan-to-value limits.
Thank you. And James, is it something that you would ever consider doing yourself? Have you ever thought about?
Love to do it.
Really?
Love to do it. It's not as easy as that, obviously, certainly where we live, the land's very, very expensive around there. But obviously, it's certainly an area that I would personally look to do in the future. But yeah, if I could ever find a barn to convert.
And so do you think perhaps finding the right area to do this type of project is really critical to it being a successful development?
I think the most difficult thing is plots of land, certainly in the area that I am, and I'm imagining where you guys are in sort of London, plots of land are an absolute premium. And invariably before you as a client has become aware of it, builders, developers are already aware of that and are already drawing up plans to do it. I think if you can find a piece of land, then fantastic, go and do it, because ultimately, even if it's a barn conversion or a self-build for a single unit that you're going to live in, that ultimately will cost you less than it will to buy that sort of finished unit. And you build it to how you want it. So yeah, absolutely. If you can find the right piece of land and make sure you can get planning permission on it, there's finance out there to help you do either conversions or build your own home.
Brilliant. Well, we'll all keep searching then for our dream barn
See
conversions.
one, let me know.
Thank you. That was really interesting. Tony, I'm going to go to you now with our next question. And it's from someone as a landlord. She says, as a landlord, I want to run my properties as a business in such a way that they can be profitable month on month. But by employing people to help me run the business, I can reduce the tax liability. Is this a common way for landlords to work when they've got more than a couple of properties?
It's not so much how many properties. I think, the bigger question is being driven by tax. And don't let the tax tail wag the planning dog. It comes back to making a business decision.
Right.
If I'm at the limit of my expertise, physical capacity, does it make sense for me to employ somebody to do the things that I can't or that they're better at? Will it add value by freeing up more of my time to do the things that I'm good at, which is creating wealth? It's pointless to pay out a salary just to save 20 or 40 pence in tax. You've had to pay out 100% in order to make a small saving. Should you employ somebody? Where's the business case? What does it add?
So really ask yourself those questions before going ahead with a decision like that.
Absolutely. Yeah, I mean, that's part of a much bigger point, but we'll no doubt cover that on a different session.
We'll look forward to it. So you wouldn't say that there's a set kind of number, once you've got 5 houses in your portfolio, then that's the time to employ someone.
We've got clients with significant portfolios, 120 properties plus, where it's still literally, as our American cousins say, a mum and dad business. It's just the two of them. They don't have much of a life. However, they enjoy it. It's what works for them. Could it be more efficient if they had members of staff? Quite probably, but
They've obviously been successful.
Whatever works.
Yeah, fantastic, brilliant. Do either of you have any advice on whether there's a time you think is appropriate to employ other people?
Well, just one point on what Tony said there, the strong logic I think applies to a range of other business and investment decisions is that tax decision. I think the question was around should they employ people for tax efficiency? And you shouldn't really do anything for tax efficiency.
Right.
It should be about the investment or what makes sense as a business case, and then the tax comes after that.
Yes, absolutely. So put that second to what is the right decision for your business at that moment in time.
Yeah.
Brilliant, excellent, thank you. Great advice. Well, I'm looking forward to our third golden nugget of the day, and it's coming from you, Tony. So what advice do you have for our viewers?
I think it's already been covered actually. Don't let the tax tail wag the planning dog. The goal is about making wealth. You only have to pay tax when you've made some money in the first place. Look at what you want to achieve for yourself, what your commercial goals are, and then start to seek advice as to how you can make the overall business more efficient, which may in some cases actually be paying less tax. In others, it may be paying more. Why? Because the lenders say, we need to prove you've got sufficient income to service the loan. So that year at least, you're going to have to pay HMRC a bit more money. But you're getting something in return for it, being the ability to borrow more than you might have otherwise.
It's an excellent piece of advice, Tony. Thank you for sharing. James, I know you definitely have some experience in this, in the tax field. Do you support Tony's views there?
It's not. I'm not a tax specialist. I'm in the finance side of things. So obviously, I'd always cow down to Tony's advice on tax. However, what Tony's saying there in terms of tax planning, and historically, people have always looked to reduce tax. Yeah. It's always been about get tax down, get tax down. But as you rightly point out, when it comes to obtaining mortgage finance, whether that be for a buy-to-let, which is now being checked more on income, or a residential, actually paying more tax and having that higher income is actually what's needed to borrow what you need for your own personal goals. So don't always be absolutely driven by getting the tax as low as you possibly can and declaring as low an income as you can possibly get. Do have half an eye on what you actually want to do in your own life, because you need to be able to prove income, and in most cases the more chance you've got of doing what you want to do.
Unfortunately, that's all we've got time for today, gentlemen. Thank you so much for your fantastic answers and for sharing your time with us today. I know you're all extremely busy. And thank you to you for joining us at home and for sending in your questions. If you'd like to get involved, you can email us at info@property-tv.co.uk, or even better, why not download our app where you can ask questions and find all sorts of information and advice. Thanks for watching, and we'll see you next time.